Okay, so welcome everybody. Wanted to look forward to an engaging discussion we have today with a very good friend of mine, Tim Seymour, and obviously Aditya, who's obviously on the executive team. But we will have a really good discussion around the marketplace, what's impacting today's investor, how we think about thematic themes for 2022 and beyond. We'll hopefully keep it engaging discussion. And we'll be, having questions at the end. So, feel free to kind of ping your questions to Tyler if you can, and then we will kind of aggregate those and have some questions at the end. I would like to just a couple of points just to raise out the gate. The views here are those of the speakers. Please don't deem this of any investment advice. I don't think we'll be digging too deep into specific names, but we're going to talk thematically around industry trends and what's impacting the investment community today. So, hopefully you'll find it super helpful. Now, just to give you some introduction on my background, I've obviously been with Prove here for a year now. My background by trade, I was an investment banker for 25 years, all primarily focused in the equity trading space, 18 years at Deutsche Bank and 5 years at HSBC, and have a kind of a broad view across, general equity markets, fund and treasury kind of environment as it relates to kind of hedge funds and the alternative investment community. And then dipped my toe into technology, where I was the CEO of a capital markets fintech firm for 3 or 4 years, spun out and sold that business. And here I am now working at Prove and thoroughly enjoying the journey that we're on. So that's the introduction from me. Aditya, if you can give some of your background, it'd be really helpful.
Sure. Thank you, Paul. And thank you, Tyler, for taking care of, of the logistics here and getting us to this point. By the way, I took the memo seriously, Paul, and I dressed up for you.
You certainly did. You look like a banker, actually.
There we go. There we go. It's rubbing off. So I'm excited to do this here with Paul. I feel like most of us here at Prove, we have been in fintech, fintech people for way longer than mainstream media, has been talking about fintech. And I feel like we're at a point now after, I don't know, maybe a decade or so of doing this, both at Medici as well as now part of Prove. A lot of us probably feel like, wow, I've been saying this, I've been working on this, I've been, part of this fintech journey for so long, and it took so long for financial markets to understand what fintech finally means. And so now to talk about this kind of as an educated person, and I speak for all of us here in fintech, which has now suddenly become, kind of the buzzword of the day in financial markets, I feel it's a great time for us to have this conversation. So thank you again. I'm looking forward myself to hearing from Tim. So, I will be brief.
Great. Tim, over to you.
Aditya, Paul, thanks for being here. It's certainly an incredibly interesting time where both fintech and capital markets and the secular trends going on in technology as they're coming together in the markets are incredibly exciting. Two quick secs on my background. So I am also a capital markets professional for the last 25 plus years, probably the last 15 or so as a hedge fund manager. I am somebody that gravitated towards the emerging markets as an asset class in late 90s. Actually lived for a couple of years in Moscow, was partners in a Russian investment bank, and ultimately then went on to manage a long short EM hedge fund for about 13, 14 years. I'm currently very involved in the cannabis industry. Speaking of evolving asset classes and emerging asset classes, I run a cannabis ETF, as you can see the ticker behind me. But I'm also, very involved on the hedge fund side and advising companies in the sector. My other job is I've been appearing on CNBC for the last 15 years, and it's been that long on a show called Fast Money, which is 5 to 6 p.m. every night, and we're proud to kind of be like the market wrap-up show. So after the the market closes, we're there to talk about the important themes, both for markets and obviously secular themes, just like the ones that I think we're probably going to get into tonight. So it's been a pleasure to be, and an honor really to be in a position where we are every night kind of bringing people behind the scenes of the market and talking about some of these really evolving, fascinating issues as they relates to not just markets, but obviously the business community and the companies that are shaping the world of today and tomorrow. So great to be here, and this is going to be a fun conversation.
Sure. Right. Let's get going then, Tim. And Aditya, obviously, feel free to join in as we kind of scope the conversation. So I think what we can't escape right now is the supply chain issue. Everywhere you turn, there's news on flotillas of ships hanging off the coast of California. I was even reading the last few days about buy your Christmas gifts now because it's going to be too late because you can't get them.
Yeah.
And then you've got the inflationary pressure. It's the highest spike in 30 years. It's, is this real? Is it not real? How should we think about this from your perspective, Tim? And it's, everything from cost of construction and raw goods, it just keeps going. I'd love to get your viewpoint on this.
Well, it sounds like, that the lead-in music is particularly relevant because, maybe we're living on a prayer, not only that Santa will drop those presents under the Christmas tree, but that issues that the Federal Reserve and some of the bigger, drivers of policy in our country and around the world have told us that some of these issues are things that we shouldn't be concerned about, that they're transitory, and that ultimately, supply demand balances, both in terms of how they play out in the logistics and the ERP and the way the world moves products around, or things that will soon kind of rectify these imbalances. Of course, this introduces a whole dynamic, and you talked a little bit about, and you referred, we have arguably a major inflation problem that nobody wants to talk about, and supply chain dynamics are only adding to that. But I think if you think about the world we live in and where we are, some of these supply chain dynamics are a function of a COVID and a post-COVID environment. Some of these supply chain factors are a function of geopolitics, and where I think certain parts of the world are not as, let's put it this way. I think the globalization trends that we saw in the 90s and the early 2000s are things that have very much moved in reverse. I think they've added to supply chain dynamics. I think obviously you have certain parts of the supply chain, especially into nanotechnology and semiconductors. They're really a function of how the world has changed. The fact that, Ford Motor Company last night reported earnings, and we were on at 5 p.m. as these numbers were coming out. It's always kind of exciting during earnings season to go through that. Ford, look, the future's never looked brighter for Ford on some level, except for the fact that they can't deliver cars because of the automotive semiconductor shortages forced them to take a $2 billion charge in the second quarter and guide the third quarter was going to be a very difficult period, even though more people want to drive cars than ever for social and also reasons just that the average age of a car on the road is probably 8 or 9 years old, and believe it or not, it's never been older. Ford said, guess what? We're actually seeing some thawing in these supply chain dynamics, and are pointing out that in the third quarter they actually distribute 67% more product than they could in the second quarter, and that it probably gets better into the first quarter of next year, but that they're still very wary of these things. The fact that automobiles and big industrials and almost monolithic old school companies like Ford and GM, frankly, are so intertwined with today's technology trends. And that's great news for not only consumers and the cars they drive, but for those companies as well. But, back to supply chain, because I could get lost on this. I mean, the fact is that semiconductors there's not a company in the world, almost certainly not in the industrial world, let alone the technology companies, that aren't exposed to this. So I think the interconnectivity between industry has never been more keen and acute, and that's part of this story. So yes, supply chain, inflation, and obviously a really exciting time in technology.
You hit on a point about Ford, and obviously, Tesla tripped through $1 trillion market cap. A bunch of the big tech names have had their earnings this week. I think Apple's going this evening. It's a strong market, right? Obviously, there's volatility with that, but irrespective of kind of the supply chain inflationary pressures, there's a segment of this market that keeps moving forward. And on the Tesla, point, they're priced like a tech company versus automotive company. And what's your thesis and views around tech, and even my Tesla is just curious for me as a function of how it's priced, but love your views.
Anybody that's been watching CNBC and has been watching our show knows that at various times in the last couple of years, I actually was vocal on my view that I thought Tesla was great technology, an innovative, disruptive company, and a company, though, that I thought had major balance sheet issues, and a company that I thought might even have trouble surviving, a couple of years ago. And look, not only was I wrong about that, but I think the argument that Tesla's valuation has never made sense has obviously been the wrong way to look at this company. There's no other way to say it. The company is now the newest minted member of the $1 trillion club, and this week, some exciting news for Tesla is that Hertz Rental Car is now going to be buying 100,000 Tesla cars for their fleet in the next year or so, which, by the way, is 20% of what Tesla produced for their entire global production last year. So not an insignificant amount of production that they're looking to buy, but to add EV to their fleet and to expose a whole new consumer class to what it might be like to drive a Tesla. Major moment in time, not only because it shows that the company has the ability to produce and execute on a major scale, at least on a scale that was unheard of, I think, for the company even a year ago. But the addressable market for EV vehicles and what Tesla has done and how they have forced Ford and GM to innovate, maybe at a faster clip, ultimately means that they're probably doing all of these companies and all of us a major service in how this technology and how their company has probably changed the world. Clearly, folks that are with us today, I bet there's a few very happy Tesla stockholders, and I'm not one of them. Fortunately, I'm also not one of those guys that got short Tesla, because that was a suicide trip and something that I recognized. What I didn't know in terms of what at least were some of the old untenable dynamics of the company. But look, Tesla and mega cap tech companies have been on an unprecedented run. So you're talking about markets, and you're talking about some of the leading companies in innovation, and they've driven the markets along with a lot of other factors, frankly, to all-time highs. And so tonight, you're right, we've got another $4 trillion of market cap in Apple and Amazon. Depending on who you ask, maybe the two most important companies in the world, or two of the top 5 most important companies in the world. Tuesday, we had Google and Microsoft who reported monster earnings. And again, NASDAQ and S&P effectively at all-time highs. So we're at a place in markets where the biggest companies are executing. The profitability for these companies has never been better. The valuations and what investors in the market are willing to pay for these companies has never been higher. And that should make you either very excited or very scared. I mean, we're at a place here with markets where the Federal Reserve just pumps so much money into the world and the markets that investors have no choice but to chase growth. And so traditional investments in more brick and mortar or even in fixed income investments have been pushed around. Although, again, what's even scarier is that bond yields on a relative basis to their fair value might even be more expensive than equities. So again, living on a prayer, Paul, very possibly. But the prayer is that the Federal Reserve doesn't change their ways, because if central banks start reversing course, I think it's going to be an extremely difficult time for markets. And they've set themselves up for a task that I don't think anyone knows exactly how they're going to unwind this liquidity. So.
Definitely. Let's kind of change tack here a little bit, and obviously pull Aditya into the discussion. Look, love to give a perspective on global growth, impact of what's happening in emerging markets versus here in the US. You know, obviously, Tim, you've obviously got emerging market background. Aditya, you've got a very strong perspective around, you know, the world you've been in previously around emerging markets, APAC, India. You know, let's start with you, Tim. What's your perspective of what's going on in China right now? What's going on, you know, in the emerging economy? What's the impact there from a developed market standpoint? That'd be good. And obviously then we'll pull Aditya into the conversation.
Well, first of all, you know, from a China perspective, and in terms of, you know, the EM growth miracle that was, you know, 25 years and is still going and will continue to go. Developing economies, especially Southeast Asia, frankly, at this point, are probably the most exciting growth story in the global map. But there's a lot of cyclicality in this too. So China just printed a GDP figure of 5.4% last week, which honestly, if you'd asked market players and economists 10 years ago, you know, how would the markets respond to that? Because China has been growing, whether it's engineered and whether it's, you know, been whether those numbers have been accurate or not. China's been growing north of 8, you know, to 10% for 20 years, so it seems. So the fact that China may be slowing is a function of you know, a handful of things. First of all, a law of large numbers, an economy that still hasn't fully transitioned and may never transition to a market economy. The fact that clearly there are dynamics in the global industrial world around COVID right now that are challenging. But look, I went into emerging markets investing because you know, I was a student of the globe and felt that the most interesting, compelling stories were not only that these were demographics and demographic groups and that were going to show the most growth and were coming to market, so to speak. Developing economies, by the way, we used to call them third world economies. So fortunately, socially, we've adjusted our language on this, like we have in many other places. Fortunately, socially, but these are countries that their economies are growing up at a time when these, again, secular thematic trends in the world around technology, you know, e-commerce, logistics, ERP, all of the ways of software and nanotechnology are changing the world. So the sophistication in which these companies are coming to market, so to speak, is at a pace and a leapfrogging of technology where it's probably never been more exciting to be looking around the world and seeing growth and seeing innovation, even though having spent a lot of time investing in other parts of the world, I'm still very happy that I spend a lot of my time investing in the US, because I think the level of innovation here, combined with accountability, corporate governance, depth of the capital markets, sophistication of the regulatory environment. These are all things that sometimes we take for granted in this country. And I think they're things that we really have to take stock in and obviously continue to support.
Definitely.
Aditya, let's get your view on this, because I mean, I don't know where. Again, this could be the first part of a 20-part series that we begin today.
No, look, I mean, I think the last thing you said is so true that we still call those countries. I don't think we call them third world anymore. I think people have generally learned to move away from that and be a bit more politically correct. But we still call them emerging economies. Emerging in what sense? I mean, again, if we were to just be a bit more debate like here, if you look at the technology innovation in some of those countries, they are actually ahead of us here in the US.
Yep.
I mean, what we are seeing happening in China and Southeast Asia and even India, technologically they are ahead, right? They obviously don't have the regulatory infrastructure and the transparency and the accountability, which is what, like you said, we take for granted here, and which is what makes our financial markets more robust and investable. But if you talk about technology innovation, we are actually behind. I mean, just look at payments, for example. We still cannot use the words real-time payments in a real sentence in this country. There is no such thing, right? We can barely say faster payments. We don't even say real-time payments for a white paper that the Fed will publish. On the other hand, if you go to India, there is a plug-and-play real-time payments infrastructure that was put in place by the government. Go nuts, right? Build on top of it. And I think that's where and I've been answering this question actually for a long time, which is, why don't we see in this country an Alipay? Why not? Why haven't we seen our big techs from the West Coast do to the banking industry what big techs in China have done already?
Well, I think it comes back, I think, to the regulatory framework. It's just so rigid here that just any new incumbent comes in, the barrier to entry is just super high. Right. Look, it's changed.
And I think that works both ways, right, Paul? Because I feel like, the advantage of having a robust regulatory infrastructure that everybody adheres to, that also becomes a moat around the incumbents.
Yep.
Right? It is very, very difficult for Amazon to eat Wells Fargo's lunch. Can't do it. It is very difficult. It's very difficult for an Apple to eat Visa's lunch. Can't do it because the business models are intertwined with the regulatory infrastructure, which actually makes it harder for tech innovation to make an impact. And I think that is a fundamental difference in my mind between how we see the US as kind of, yes, it's a classic, capitalism catalyzed engine of growth. You may not have pure capitalism in China. You might have, maybe with caveats in India, but you are seeing technology leapfrog faster. So I think there's some very interesting factors that I think we should at least observe, right, as we sit here.
It does lead into one of the biggest disruptive elements of the financial marketplace today, and that's crypto, right? Regulations creeping in. Everybody's putting up their crypto shingle in some shape or form. And look, it is in the midst of transforming this market. And even this week at Money 2020, it was my first time at the conference. There's obviously 8,000 people there. It's a very renowned conference. Crypto firms everywhere. They're not crypto and in their own industry vertical. They're now part of the capital market, financial market, consumer market environment. And it was incredible to see. Everybody's, finding some new mechanism, either from an execution trading standpoint to participate and come up with a new coin, or even from an infrastructure perspective, finding new mechanisms to make even traditional markets more efficient. And I think that's a fantastic pathway forward because the market still is fragmented. And, this is not even talking about NFTs, which is obviously on the far right. But yeah, love to hear your opinion, Tim, on the crypto world and where it's taken us.
Well, yeah, and I'll transition there from, again, taking some important elements of what Aditya said, because again, you have these competing forces of decentralization against the natural. I don't need my government to do a lot of things for me, but I do need them to protect me. And I need them maybe to to regulate certain dynamics in the financial markets that I think are somewhat important. So, I think ultimately where we're going in this country, and Aditya brought up, I mean, look, China's version of a market economy is what's appropriate for China.
Yep.
American democracy doesn't work in other parts of the world. I lived through Russia in the mid to late 90s when the Soviet Union fell. We all presumed, and we is not necessarily any of us here today, but I do think this whole globalism that was sweeping the world, and it was an exciting time. Let's face it. I mean, there was a little bit of this whole "we are the world" thing, and Paul and I have been at a karaoke bar too, and he's particularly good at that one. But I think you've got a case here where we have a better understanding both in this country and around the world, but I'm not sure it's necessarily going to change how our policies and our politics evolve very quickly. That we believe, that our form of democracy is right in other parts of the world. It's not, and it's not necessarily going to work. And the same thing about, getting into crypto and decentralization. You still have to take a step back, and a couple of the oldest cliches or adages in the financial markets world that have also affected emerging markets people more than any is our dollar, your problem. So our central bank, your problem. And at some point, it's unsustainable. And at some point, the US as the reserve currency and economy is deep and as sophisticated and as strong as the regulatory environment is, at some point, the Roman Empire will fall. And we've seen it before in history. And I think crypto and both digital framework, but so many other things we've already touched on are part of what's going to lead that faster. So there's a natural conflict between the US Treasury and what's going on with crypto. But people that are involved in the blockchain and whether it's actually using it for transactions or at least establishing other forms of value storage. I think there's also a misunderstanding that there's no place for regulation here. And so the good news for crypto is that I think soon enough, the SEC, and we've seen that with the advent of Bitcoin ETFs, the more regulation, I know this sounds antithetical, but the more regulation we have here, I think the higher the asset values are going to go, at least for some of the major standards. So fascinating time in how the public markets are evaluating ways to invest in crypto and digital transactions and blockchain.
And look, I completely agree on that point, Tim. Right, that regulation in crypto will actually help people. I believe that too, because what you see right now is a lot of people kind of sitting on the wayside because they don't want to touch crypto. They feel like something bad will happen because if they are responsible for investing somebody else's money, for example, they don't want to be hit by something and be surprised, right? So I feel like there's a lot of folks who see the value, what crypto can offer, but because regulation is either ambiguous or not there, they're staying on the side. Right. And I feel like, and somebody made this comment to me the other day that, if there were one reason I'm in the crypto space is because it is attracting the smartest people in the world. And there's something to be said about that, right? Your top talent as they're coming out of school or as they are, choosing where to go, they're actually choosing to go into crypto and blockchain. It used to be that a job at Google, Facebook, Amazon, Apple was like the most coveted job for someone coming out of college. I don't think that's necessarily true anymore. And before that, it used to be the banks, and before that, it used to be the.
I was going to say, if for us,
know,
it was to get a job on Wall Street, and
yeah. But how things have changed, right? So if you talk to a Gen Zer today, their aspiration is not to work for Facebook or Google or Amazon, and this has nothing to do with kind of recent stuff that Facebook has been in news for. Nothing to do with that. That's a totally different topic. But I believe that, like you said, crypto is the next thing, and if that is the next thing, then everybody has to give it the guardrails so people can go into it confidently. And I think, again, this is also where, we look at how, say, China has publicly been looking at CBDCs, and we are still kind of stuttering. So I'm happy that you put the crypto question in that context. And
what's been refreshing for me to see is that they're looking through this through a fresh set of eyes. That there's been hardly many people who have had a Wall Street background that have gone to crypto firms. There are, even this week, some folks I met, wouldn't have ever thought about, getting a job on Wall Street, and here they are transforming the capital markets as we think about it today, right? It's incredible to see. Yes, there'll probably be more people moving across. A good example, my traditional role in banking was always in prime brokerage, and you'll see a lot of crypto firms looking at lending crypto, interest yielded products. That type of investment event has been happening in capital markets for the last 30 years. In crypto, it's brand new. So, how do we make that transition to traditional market type mentality? Look, it'll come with time. But this is incredible. And I think that just the transformation play of the infrastructure, we're only at the start line. Like, if you think, are we all missing out? What should we be doing? I think, this journey has just begun. We've just got such more of a runway to kind of move forward on. It's incredible.
Yeah, it's look, and again, the terminology, the understanding of the three-dimensional planes that we're kind of thinking here. It's totally different space, different space, and acknowledging that my kids are going to are already thinking differently. Even at the age of 13 and younger than I was able to think at that time. I suddenly feel a lot better about my 8-year-old spending way too much time on Roblox and the metaverse. And because, if it's good enough for Mark Zuckerberg, it should probably be good enough for my 8-year-old. Although I'll leave that one alone too, because I realize Facebook is not necessarily everybody's favorite company right now. And all I'll say about that is I believe that ultimately social responsibility in the corporate world and in the investment world is something that also has evolved tremendously. Yeah. And that, sure, investors used to walk with their feet. And so, in other words, if you don't like what a company's doing, you can sell their shares and do what you want. But I do think that social responsibility is not necessarily just viewed as a carbon footprint. It's not necessarily just viewed as the ads that we're willing to put up there, and obviously the tone around media. And I mean, we're reinventing how we think about this, and as investors. And so corporate accountability, by the way, bringing it back to the blockchain. I mean, one of the things that I think is going to be different about tomorrow's stock market is corporate governance accountability will be hard coded into how these companies trade. And I think that's great news for investors. That's great news for society. But again, Facebook's on some level an easy target right now. And by the way, maybe deserve everything they're getting. I mean, I recognize that you have to get to all sides of these stories these days, because depending on which media you read, you're going to get a different angle. And my guess is, most people here like to go and read all extremes of media, which, by the way, I think makes sense, because the conversation it's good to know what everybody's saying. So anyway, I mean, I think we're at a place here where there's incredibly dynamic forces shaping how we invest and how some of these companies are operating. But the world of crypto, I think is almost the, and digital, both payments, but also the globalization that we are seeing, not the globalization that's being unwound in terms of borders, but where technology is breaking down borders. This is the backbone of where we're going tomorrow.
Let's align with your view on, you could argue, informed and uninformed investors. We can't ignore the Reddit phenomenon. Robinhood has, in some respects, latter part of last year, democratized, the marketplace for the average retail investor for good and bad. Obviously, the volatility that's been brought into the marketplace. You've got a new breed of people trading on margin, trading options who probably shouldn't be, or maybe they are educated. I'm just naive at this point in my career. Love your perspective, Tim and Aditya, on what has happened in the last year. You've had, I've always got CNBC on the background here. They just talked about Naked Wines that has gone up, was up 150% this morning, and I think it's now down to 100% up.
What do they do?
Naked Wines are a wine distributor or a wine company. I didn't even get to the bottom of it. But again, the rally around this stock, even just intraday today, I'm sure you'll be talking about it on Fast Money later. But it's just crazy. Love your perspective, because I know that's going to impact a lot of the folks in the office. People who had never thought about trading before and have all got a Robinhood account or whatever the equivalent is. It's actually great. I think people should have some money in the market and have a perspective and a view, but it's having an informed perspective, not an uninformed, just chasing a name that's rallying, from my perspective.
Well, this could be another 20-part series, because again, the whole Reddit phenomenon is both the democratization and where Robinhood has played, and retail investor versus the institutional investor. And look, as we've had to talk about stories like GameStop and AMC on Fast Money, I have to be very careful, not only to sound like I'm not a boomer, but not to sound like that guy, because there's on some level, there's a social movement here, and there's at least a view that even just in market circles, that the retail investor has been, the game's been rigged, and there's been no opportunity for the retail investor to compete with Wall Street and the suits and the hedge funds and whoever. So there's that element. Then there's just the element really of trading and investing and where are people speculating with their money? How much are they speculating with their money and disposable income, or not disposable income, but actually, primary assets? And again, what are they speculating in? So look, from my perspective, GameStop, AMC, and some of the Reddit dynamics, when it's explained to me as, kamikaze investing, I think that's the stupidest thing I've ever heard. Who should be investing to make a point and lose their money? We just talked about the opposite, right? We talked about social investing and actually investing for purpose and change. That makes sense to me. But believing that some hedge funds were trying to destroy GameStop and that's not fair, and we're going to drive them out of business by those who are short. And for the quick lesson for those who don't follow some of these market dynamics every day, because by the way, a lot of people don't. But big hedge funds, not even necessarily big hedge funds, but if I think GameStop's a broken company and a company whose best days are behind them, because the days of hardware in gaming and in a world where people are moving into, and the space has moved into multiplayer games that are done on the internet and done across anyway, the point
buying Blockbuster stock today.
Right. No, well said. Well said. And or listening to Bon Jovi's "Living on a Prayer" with my Sony Walkman. But I acknowledge that there is some, sense of first of all, a different group that has embraced investing and trading and is voracious about it. By the way, I think that's obviously great because I think the stock market maybe certainly after the financial crisis for 5 to 10 years, and maybe even before it, had disenfranchised so many investors into thinking that they just didn't want to put their money in because they didn't feel like they could compete. So look, I think between both crypto and the empowerment of a retail investor and bulletin board kind of social media like Reddit, that is an informational source to helping folks in a community that is really seeking to educate and not manipulate. Like, that's all great stuff. The best news for the retail investor, and this is something that I actually, I have had to try to explain on CNBC, and I think there's still a healthy amount of skepticism in some circles about this, but I don't know that the institutional investors have that much better information anymore than the retail investors. I can tell you as a guy that ran a hedge fund for 14 years, it's not like we had some holy grail of secret pipeline. I mean, markets are efficient places, but there's a lot of free data sources on the internet right now. And there's a lot of places where you don't need a big research budget and five or six analysts to get good information about how companies are performing or not performing.
That's the point. It's the point here. You've got folks doing fundamental bottoms-up analysis of why they will buy or sell a stock versus it just coming across a news feed and everybody's piling on. But
and I think maybe this is this might be a place to kind of split hairs between investing and trading.
Mm-hmm. Yeah, for sure.
So I'll give you kind of a real life example, close to home. So guess what was the biggest excitement for my son when he turned 21? It's not what you think.
Well, for me, that was being able to go to a bar and have a beer.
Yep. I know. So that's what you would have thought, right? But
because I've never been in a bar before then. Anyway, just kidding.
That's a different topic. But he was excited that he could now open a Robinhood account in his own name. That is what he was really looking forward to when he turned 21, right? And then he opens his Robinhood account and puts a few $100 in there, and whatever. And he's still in college, right? And then we have conversations, and this was COVID, so he was home, so we could actually talk about things at the dinner table. And I was just amazed how much he knew about stuff.
Yeah.
And he knew about options and collars and floors and this and that. And like, wow, right? And then very soon it's like, Dad, I'm thinking of a margin account. You think you can help me there? I said, whoa, okay. I said, you just told me one and you think you're a pro already? No, but I can make so much money if I did this. And that's exactly when all this GameStop stuff was happening. And, I said, look, ask your mom if she's going to give you any play money, right? And, if she's okay, I don't care. I trust your judgment. And she agrees, and he gets into the GameStop thing, and this is and then he convinces me, Dad, why don't you open one too? I said, no, I'm done with all that. I don't actually trade stocks anymore. But he convinced me, and whatnot. And then fast forward, as we saw it play out in the news, he actually got stuck when they halted trading, and he had some open positions, and he was very frustrated. And I don't think he lost money, but he definitely wasn't able to make what he thought he could have made if the markets hadn't been shut down, or if Robinhood platform hadn't choked when it choked, right? And so my point is that, okay, look, it is good to be an informed investor, but when it comes to trading and making money off of trading, there will always be people with better technology, better access. Yeah. And information is not the only tool. Information asymmetry is probably gone, but there is asymmetry when it comes to you being able to move billions of dollars versus $1,000. There will be an advantage for the big guy. And
it's also what is an expected return. An average person investing a few years ago would have been happy with an 8% return or a 10% return on their portfolio over a year. Now, people don't know when to sell. Like the stocks are, pushing around 25, 100% or whatever it is. When do you sell your position? Yeah, and especially for the newer investor.
I don't know. I mean, look at
crazy.
look at Apple. I mean, look at Amazon. Being long-term greedy sometimes is the hardest thing to be as an investor. And but I hear you. And I'd say, by the way, this week Robinhood reported. Stock dropped 9%. I think it's down another couple percent today. Stocks below the IPO price and probably 60% below the intraday highs it had hit after the IPO. So what is that telling you? The contrarian in me, first of all, still believes that that's a very loyal, engaged platform of investors. Dogecoin is not a business model. So, that's part of, what they saw is that their crypto revenues went down. But again, everything we just said earlier, a lot of those investors, Aditya's son, an engaged next wave of investors that are looking at some of the most, again, the products that haven't been invented yet. And on some level, Robinhood, maybe the best thing that they've created is attaching that name to a brokerage, online account. But I actually think Robinhood's going to be okay, and I actually think that the power of the engagement is on some level, and I can't equate it back to a Tesla, but even some other, even a GameStop. I mean, look, AMC is a perfect example of where the market actually turned into truth, even though, again, we're not going to more movies in the theaters anymore, and streaming and the death of linear TV is a reality, or the movie theater. But AMC was able to go raise money because of the support in the markets and fortress their balance sheet, et cetera, et cetera. So I guess what I'm saying is, Tesla, when they were losing money and couldn't produce cars for the price that they said they were going to, but still had a great idea and great technology, managed a way to, with again, I don't love how it was done, and I think the standard rules of disclosure and the regulatory environment around this company got very fast and loose. And what was promised versus what was delivered. But at some point, the most loyal investor base in the world, because some of them own Teslas, or some of them just believe in green technology, or some of them believe Elon is God. All of these things may be true, by the way.
We'll all be driving electric cars in the next 3 years anyway. So,
but Tesla is extraordinary. Anyway, Robinhood investing, a new investor class, exciting times, new investment products. We may not have, think about the evolution of the stock market, where at one point stocks were really literally paper certificates that were signed into a registry. And so, to the NASDAQ, the fact that IBM is still trying to do what they do, and then you've got, you've got other computer companies that don't even know what an IBM mainframe is. Investing in stocks as we know it, and buying Apple stock as we did, as you might today in your Schwab account or your E-Trade account, tomorrow may be totally different, and you may own it in digital form.
Cool. Let's do this. Why don't we open up to questions? If anybody wants to unmute themselves, ask away, or ping Tyler Do with any questions that way, we can open up for questions. I think the three of us could keep going forever at this point. As you said, it's a 20-part series. We haven't even touched on really payments, what's going on in social and diversity agenda as it relates to kind of investing in stocks. We got
while we're waiting, let me ask Aditya a question from the payments perspective, and again, less about the technology but more the concepts. Affirm last night announces a deal with United Airlines that the buy now, pay later is moved into the world of buying your airline ticket. I mean, why is this seemingly, so evolutionary, revolutionary, when in fact we've had credit cards to do installments on forever? And is this a game changer in your view? And as a segment, what do you think about all this?
I mean, I'm bullish about this segment, right? And I think there's a couple of kind of facets here. Why now? Why bother? Because now technology can, right? I mean, to be able to make a small loan in real time and assessing the risk of the borrower, in real time, that is possible today. It wasn't possible until recently. You actually had to go through a process to see what is the appropriate interest rate to charge this particular borrower. Now, technology allows you to do it almost instantaneously.
Yep.
Right?
Or there is no interest rate.
Right? So that is a big difference. And you are able to do it in micro quantities. Now, obviously, an airline ticket is not a micro quantity, but still, you can actually make a small loan because the cost is zero. I mean, if you think about why the big banks stopped making small business loans a few years ago, which is what led to the whole business lending segment of the cabbages of the world, because it was too expensive for the banks to make small loans. So they gave up. They said the cost of acquiring that loan is way too high. Again, we have now solved that problem. Okay, we can now make small loans in real time by assessing the risk almost perfectly. And so let's go. This is going to scale. Now I expect this to keep growing. The other facet, which was surprising for me even, is that, we always talk about the millennials and the Gen Zs, supposed irresponsibility, that, they are not responsible spenders, at half credit card will spend. The reality is that, they're actually quite responsible. And in fact, there are studies which are saying that BNPL is being used by that generation as a way of money management. Okay, because now they know exactly how much they'll be spending in the coming months, for the next 18 months.
Yep.
It has become certainly a personal financial management tool. I know it looks like quote unquote irresponsible impulse buying because BNPL is there, but that actually allows them to plan ahead, which is why, like I said, I'm quite bullish about this.
I think Aditya, your key point around assessing the credit risk here and now is incredible. Like a live example, I was in Best Buy a couple of months ago. I was about to buy another 60-inch TV, and the guy was like, "Would you like to use buy now, pay later?" I was like, "How long will this take?" It was done in 20 seconds.
Yeah.
It was an interest-free loan I'll pay over the next year. I'll do that all day long. But the flip side of that agenda, though, is that where people do that too much and they've got too much exposure, and you push the problem too far the other way. And then the other good point here is you intersect a company like Prove. We can only ever make these experiences even better as we think about our onboarding experience with pre-fill, authenticating the identity of an individual faster behind the scenes, our trust score kind of, competencies. This is just going to go far and wide. But it's incredible. And this is really a standing start in the last 18 months, where a firm's gone to Klarna and Afterpay, and now every bank is just pushing into the space as well now. It's crazy. Tim, let's talk about companies that have gone IPO, right? You've covered tech companies, a breadth of companies that have gone IPO. Love to hear about views, any stories or anecdotes you want to kind of push forward.
Well, again, I think, first of all, talking about public markets versus private markets, and when it's right for a company to go public, and what we've seen this year, and the first thing I'll just say is that the private equity markets have become a lot more efficient, and that actually companies are coming to market significantly more mature than they ever have, and that really ultimately the graduation into the public market milieu is a function of, yes, I think wanting more access to capital and a diversified capital base, but it's as much, I think, really, it's more about establishing different benchmarks of liquidity and an investor base. So I just say that, I mean, the companies that we've seen in the IPOs in the last year that have been seemingly the most dramatic. I mean, everything from Coinbase to Robinhood, Airbnb.
Yeah.
I mean, think about Airbnb. I mean, Airbnb almost didn't make it on some level, it seemed, to the IPO stage, and maybe left a lot of money on the table before they were actually able to finally come public because of both, I think, internal and exogenous factors, especially around COVID. But look, I mean, I would just say that you've seen particular subsectors have more, more tailwinds, more trendiness, and that I think that's what I would just warn investors around. And again, the performance of certain IPOs, often through the first couple of quarters after the initial flurry, is a very frustrating one. So staying the course for companies that have real business models. Again, I think Robinhood may be one of those. But I mean, look back on the Uber IPO and where that stock went and then ultimately traded down to. Remember, a lot of these companies are still trying to discover profitability, and at least in mega cap tech land, that's allowed, and that's actually, on some level, investors want to trade high growth for, are happy to buy high growth and even look past profitability issues. But look, I think, again, I'm talking more thematically around what's been going on with IPOs. I think this has been such an extraordinary 2 years for the IPO market and for the SPAC market and for things coming to market, because there's so much liquidity sloshing around. I don't think this environment lasts forever. And I think this environment will, again, will be looked back upon as one that was pretty unique. And really, it's been a great era for private equity. It's been a great era for companies that know exactly where to buy a company in their life cycle and in this inflection point in where they really have a business that they've built, have some foundation for growth and are showing it, but that right partner takes them to the next level. And again, navigating the capital markets process, which is science and art as much as it is actually execution.
This does dovetail into one of the questions we've received. There's a lot going on in the SPAC market. Love to get your perspective and update there. I've got my opinions from obviously the bull market that we were in at the start of the year and where SPACs are today. But one of the questions has been what are the trends around SPACs currently?
It's slightly better, and if you look at a couple SPAC indices, they kind of track the basket of, I mean, SPACs. Coincident with this, look, the S&P is up 7.5% in the last 19 sessions. So it's basically a month, right? When you and the SPAC index has rallied with it. Like I sit on a board of a cannabis SPAC, which is actually investing in ancillary companies, so not plant touching companies that are involved in technology and other ancillary, call it picks and shovels. We waited for a long time to get this SPAC out the door, but now, in the last 3 weeks, the market's opened up a bit. I think SPACs are both much maligned and also really quite interesting. While also, though, let's be clear, a lot of companies have been brought to market that would not have been able to come to market without the SPAC structure. And I think also, therefore, have driven up prices for other assets. So, and I think, we need to still see this settle through. Historically, I think the SPAC structure was one that was a little bit more relegated to periods of extreme liquidity and dislocation in markets. I think they're real structures, and I think they continue. And I think there's some balance that's come back into the SPAC market.
Yeah, there'll be like a 2.0 version coming forward soon. I think
Yeah.
the mechanism clearly seems to work. It's a bridge between, venture raising and going public. And look, end of the day, these companies need to be public market ready, right? Are they? And they're probably coming to market too soon. But there's a mechanism there, which is good. I've just got another question. So Tom's online. Tom, do you want to unmute yourself and ask a question?
Yeah, thank you so much, and just thanks to everybody who was able to put this together. It's been an enlightening conversation. Tim, earlier you were talking about sort of shifting geopolitical risk. I'm just wondering, as a small investor who maybe wants to expose himself to more emerging markets, is there a way you think about different countries that maybe that are maybe a greater geopolitical risk for a U.S. investor now?
The question is, should you be more cautious about smaller companies and the geopolitical risk right now, or is it an
different countries? More
right.
thinking,
Sorry, countries.
Yeah. It
right.
would seem to me that just compared to a few years ago, it's a slightly greater, just thinking geopolitically, it's a slightly greater risk to invest into China right now. Whereas something like India or Vietnam, it would seem to me that the geopolitical risk hasn't changed very much there.
Great question, Tom. And usually I'll let you behind the curtain on CNBC when we have a viewer call. I've already been told what the question is. So I mean, it's a good thing I can answer this one.
But this is Jim Cramer. You got to do Jim Cramer. Take the call.
I was a little worried about this. No, it's a great question. And I have a background of investing in different countries in the world. And by the way, it's the ETF world, and country ETFs is a fascinating, it's become very sophisticated in the ability to invest in Vietnam and own a portfolio of stocks, or invest in South Africa, or, you name the country, you can do it. But so look, geopolitical risks are rooted in a handful of things. They're rooted in some of the obvious geopolitics, and U.S.-China relations are very complicated, and obviously there is a battle that will rage for a long time, and probably has for a long time. But at different times in this country, we've targeted different countries have been bigger adversaries than others. Look, control of technology, nanotechnology, the internet, and the whole concept of cybersecurity is one that with U.S. and China is look. I mean, war takes many different forms. I'm not saying we're at war with China, but the relationship now is as cantankerous as I've ever seen it. In terms of investing in other countries that really are major beneficiaries of either some of these secular trends that we're talking about. And again, Southeast Asia is to me, on some level, these are economies that are obviously heavily influenced by China. And I mean influenced because I mean simply from a commercial perspective, China is an end market. But I think their geographical proximity is that. But I think the growth there, these are domestic consumption growth stories too, that are not just reliant on Nike producing a major part of their production line in Vietnam. So I continue to endorse investing in countries around the world to the extent that you can do your work and you can get that exposure efficiently. Again, remember that if you see interest rate structure change in this country and move higher, and you see the dollar start to rally around a Fed that at some point is going to have to begin to get more aggressive on inflation, it's not going to go that well for some of these smaller countries. It's just kind of the way it goes. But I do think they are less interest rate sensitive to the US than they were. And I do think, again, the good news here is it's less of our dollar, your problem story than it used to be, but it still is. So have geopolitics increased US-China? They have. Look at Alibaba and Tencent, two of the great companies in the world. I mean, I think Tencent might be the most sophisticated tech investor in the world, and an incredible incubator. And yeah, I mean, they just happen to be, really, run the largest social media network in the world, but also are maybe the greatest gaming company in the world. I'm going to invest in Tencent. I'm a long-term investor, not trader, as Aditya pointed out. I mean, there are, and I think you could probably be a trader in these stocks too. I think it's not going to be simple, and what causes companies sometimes to re-rate is a lower discount rate and a lower, kind of risk around them. And right now, I don't see that risk falling significantly for some of these Chinese companies. But I do think that ultimately China is very concerned about their national champion companies. They do need to control them. Again, when I lived in Russia in the late 90s, the expression I like to use a lot is data is the new oil. So as a strategic asset, it used to be natural resources that were really the most important thing in the world. And I think that has shifted. It doesn't mean that oil isn't still very important, but data and control of technology is obviously more important. And I think, so for the same reasons that Vladimir Putin decided to crush a couple of private oil companies that ran ahead of the government, I think you're going to see that in China.
Yeah. So Tim, we have one more question here. Lester, I believe you got a question.
Thanks so much.
Yeah, this question could be for Aditya or Tim. I'm going to direct it at Tim just because you mentioned emerging markets and he talked about our democracy not fitting into economies like China. Question is, have you seen any companies directly address the cross-border transaction issues, kind of like either financial or non, but address that efficiently where the democracy becomes less of an issue?
I guess it's a question of whether the regulatory environment is agnostic to the business that the company is in. And I feel as if, again, there are companies that are potentially more exposed in the regulatory crosshairs than others here. I think until we, for example, get the right regulatory framework around digital currencies and crypto, I think that's still a big unknown. But I think ultimately, I think like the regulatory framework is really a function of what's permissible and federally legal and what's not, and then really about tax regimes and not circumventing, as far as I can tell, at least from this side of it. I mean, companies that are doing business outside the United States have historically run into problems here if they were being overly aggressive on their tax efficiency, or if they were involved in something that was federally illegal. So, as you get into strategic industries or industries that are closely aligned with where the government would be involved, I think those gray areas of cooperation between the public and private sectors are things that are continuing to evolve. But I mean, look at a company like CrowdStrike, or look at a Palantir, or look at companies that are involved in either cybersecurity or software that is transcendent public-private sector. Those companies now have a unique relationship with governments. So I'm not sure if I've answered your question, but as an investor, I certainly want to avoid companies that I think are run themselves at risk with a framework on a cross-border transaction, because I think ultimately that company can never re-rate. I don't know, Aditya, what do you think about this?
I mean, look, I think if we just bubble up the question slightly and talk about not just cross-border transactions, but doing business in other countries, I think it's also about perspective. I mean, let's just look at something that we would think is like straightforward. All cloud companies kind of do it the same way. Here's the reality, right? If you talk, and again, depending on where you are, you might think about it very differently. For example, India requires data centers for financial transactions to be actually physically in India, right? MasterCard has run into that issue, okay, that their data centers were not in India. And so the government said to them, if you want to do business here, you go to have data centers in India, okay? Now, is that a big deal? It depends who you ask, right? Now, if you want to do business in a country, you have to follow the regulation. You may not like it, but that is the way it is. Okay, that is the way it is. Look at IBM's cloud offering. You know, we were working with all the major cloud companies at one point at Medici, right? IBM, Azure, GCP, and IBM said, "Yeah, we want your help in this hackathon to attract startups, but don't bother looking at Indian startups." And I said, "Why?" "Oh, because we have no intention of setting up a data center in India. What's the point of attracting Indian startups if we can't actually work with them?" Now, if you choose not to do it, then you are making a choice. Is there a cost to it? Yes, there's a cost to it. Is the law of the land? It's the law of the land. Are there pros and cons of doing it? Yes, there are. But you know, I think the Eastern emerging countries are taking a firmer stand now, saying that you have to do things our way because we say so. And if they have the leverage, they have the leverage, because like it or not, the GDPs of some of those countries are going to they are going to cross the GDPs of some of the largest European countries very soon. And you know, they used to say India GDP growth when it was in double digits, that there was a demographic dividend, not a democratic dividend like we think we have here in the US, but a demographic dividend. Why? Because there are just younger people there. A higher percentage of the population is young people who spend more in a longer lifetime, and that's what makes those markets long-term more attractive. So I think it's just the reality that you have to deal with. You can't say somebody is wrong. You have to deal with what is out there and what stand they're taking.
Great. Well, I'm conscious of time here. Unless there's any more questions from folks online, I think we could be in wrap-up mode here. Any further questions from anybody? Okay. All right. Well, Tim, very gracious of your time here. Good friend. And I'm sure we'll have you back at some point again soon. We had lots of areas that we didn't really even touch on. And look, very thankful for your engagement.
This is fun. This is a pleasure. This is a really thoughtful conversation, and it's all threaded together. And you know, maybe the next time we do this, you'll actually treat us with a little more transparency, Paul, and take the blur filter off your background, because Aditya and I have decided to present ourselves as we are. And now,
you can see
great stuff
behind me if you want.
Well, you're going to ask him to sing his karaoke thing the next time.
Yeah, well. I'm not sure anybody should see or hear, more importantly, what goes on in those places. Now, congratulations to your success, and certainly you're in the center of just a dynamic, vibrant part of really almost every issue we touched on.
Yeah, thank you for taking the time, Tim. I enjoyed the conversation as well, and we look forward to more. But we appreciate you taking the time for sure.
Thanks a lot.
Great. Yeah. Thanks, Tim. Thanks, Aditya. Take care, all.
Okay.
Bye. Thank you.